A major disaster awaits Europe after a wave of bankruptcies of American banks. America deals a strong blow to the world. The wave of bankruptcy and default in the banks of the United States of America is escalating and will not stop soon because its causes are still present and increasing, which puts banks under great pressure due to the displacement of deposits, weak customer confidence, faltering lending and raising interest rates, which makes the American authorities unable to stop the series of collapses, expecting the transmission of the earthquake to Europe's banks soon and perhaps more severely. And the exit of depositors' money from American banks will inevitably lead to a banking crisis that may transfer the country and the world to a financial crisis similar to the one that occurred in 2008. Just as the growth and merger policy allowed by the American authorities and bypassing the restrictions that prevent the purchase of other banks will lead to the creation of banking entities that form a threat to financial stability. And that the American West Bank is following in the footsteps of Silicon Valley, as it announced talks with potential partners and investors regarding strategic options. And among these options is definitely selling or increasing capital after the liquidity increase announced last March failed to restoring confidence in its faltering share price after the shares of the Los Angeles-based bank and many other U.S. regional banks fell. Amid fears of an exacerbation of the banking crisis in light of the pressures facing regional banks in the United States. Despite attempts by regulators to end the banking crisis that began with the collapse of a bank Silicon Valley and Signature Bank last March. And that, hours after the news of the bank's closure and the possibility of its sale, the bank's share fell by more than 53%, thus lying to the U.S. Federal Reserve Chairman, Jerome Powell, who emphasized the strength of the U.S. banking sector. And the First Republic Bank represents the largest bank that collapses as a result of the current banking crisis. The second largest bank that goes bankrupt in the history of the United States of America. With the exception of investment banks such as Lehman Brothers after the bankruptcy of Washington Mutual in 2008. And 11 American banks tried to support the troubled bank with innovations amounting to $30 billion. But it did not. These attempts succeed after the bank's share price collapses as deposits continue to be withdrawn. America witnessed 3 bankruptcies in 2 months, namely, Silicon Valley, Signature, and First Republic Bank. Then it rose to 5 cases. And they all have one thing in common, which is that their financial statements were audited by the KPMG Group. And all of them they obtained declarations of good financial solvency until the end of last February from KPMG, which audits the financial statements of a large group of banks in the American banking system, and by the way, it evaluates the accounts of Wells Fargo, Citigroup, and New York Mellon banks, and 30 other banks. JPMorgan's acquisition of most shares of First Republic Bank failed to calm the market about the state of the U.S. banking system, as West Bank shares sank 28% to a record high, while Western Alliance fell 15%, leading to a decline. U.S. benchmark indices by more than 1%. U.S. Federal Reserve hawks only see inflation and face it. For the 10th time in a row. The U.S. Central Bank, the Federal Reserve, decided to raise interest rates by 0.25%, 25 basis points, to range from 5% to 5.25%. These hawks prefer high borrowing costs to maintain covering inflation in exchange for doves who prefer low interest rates to maintain growth rates and stop the bleeding of collapsing and troubled U.S. banks. and that those hawks who lead the Federal Reserve do not see the strong tremor in U.S. banks, which are still under great pressure due to the exodus of deposits. Or that the flow of depositors' money outside U.S. regional banks may lead to a banking crisis or a collapse in lending. Just as the inflation that the U.S. Federal Reserve fears is a big threat. The crisis exacerbated when banks used the money to buy long-term debt investments to earn more money with low interest rates, without taking sufficient precautionary measures, which exposed them to what is known as interest rate risk when the U.S. Federal Reserve raised interest rates several times in a row and quickly. And depositors rushed to withdraw their money to provide financial liquidity to continue working and pay workers' wages in light of the strict monetary policy. As a result of a liquidity crisis resulting from unexpected losses in the loan portfolio.